So we move into our third chapter in relation to chargeable gains, CGT, indeed for individuals. This one concerns shares, and for me, this is the big one. This is the big asset within TX for CGT, and this is the one that the examiner tends to target the most. He'll target all assets, but this is the one that he likes the most. That's why we've got one chapter full on it. Let's look at the first area. So let's talk about shares and disposals of shares. I mean, clearly, selling shares, and indeed, if you will, gifting shares, let's say from a father to a son, it's pretty common, yeah? And I guess that's why the examiner favors these, because in practice, in real life, this happens a lot. We've got to be able to have rigid, tight, and understandable rules in relation to the disposal of shares. So let's talk about valuation first, because obviously at the end of the day, if I'm selling a share, I need to know what its value is. So how do I do that? Well, it's pretty straightforward for unquoted shares. In other words, I've got a batch of unquoted shares, I sell them. The value, will be given the exam question, because let's remember that for unquoted or shares in a private limited company, it's quite difficult to value them because there's no market for them. If you own a company in the UK that sells widgets, how do you value those shares? Tricky. So that will always be given in the exam question. Now note, for quoted shares, the market value will be the mid price based on the day's quoted price. Okay, more of that in a moment. Nothing to worry about in terms of valuation, in my opinion. Now, this area is an area to worry about, because when talking about shares, this is what the examiner is going to target more often than not. In other words, this would be his favorite area. It's what's called identification. Okay? Now, what we mean here is, imagine a scenario where you own 100,000 shares in a particular company, ordinary shares, all of the same class, so ordinary shares. You've purchased those 100,000 over the last 20 years, okay, for argument's sake. Today, you sell 10,000 of them, okay? How do we know which shares you're selling, given the fact that they're all shares of the same class, of the same type, in the same company, okay? We need a rule, don't we? That's what gives us the identification rules. So note that when some or all of the shares are disposed of at a later date, acquisitions must be matched or identified with the disposal to calculate the gain and losses. So the ID rules, they're often called the matching rules, is very basically a set of rules that enables a taxpayer, or let's say their professional advisor, to identify or to match disposals of shares with purchases of shares. Okay? Now, we're going to develop this area in one moment. Now, the share identification rules. What are the rules that allow us to match or identify shares? So, we see that a disposal of shares of the same class in the same quoted company is matched with acquisitions in the following order. Firstly, match with all shares acquired on the same day. So, for example, you had 100,000, up to today. 20,000 of those you actually bought this morning. Okay, so that would be the first area that I would go to, in relation to my disposal of, let's say, 10,000. In other words, match the costs and identify the shares with what you purchased same day. The next area is shares acquired in the next 30 days on a first in, first out basis. Now, you may be thinking to yourself, what are you talking about? I've got a disposal of shares today. What you're saying is match them against shares that I purchased in 2 weeks' time? Yes. This is a rule. Now, the reasons behind this rule aren't overly important to us. It's called bed and breakfasting. But But in essence, there's a good reason for it. We don't need to know about it. We just need to know that in fact you would have to, if you didn't have, let's say, same day shares purchased, match shares in the next 30 days. A little bit odd, but that's the rule. The last area is shares held in what we call the pool. Okay? So what we mean by that is, broadly speaking, any shares from yesterday back to the year dot. So let's think about it. You know, if I didn't purchase them today, if I didn't purchase them in the next 30 days, what's left? Well, anything that I purchased from yesterday for the last 20 years, they're all historic shares in this pool. So, excuse me, note, this is the order that we match a disposal of shares on. So again, the scenario was you have 100,000. You purchased them in the last 20 years. Let's say some you purchased this morning, some you purchased in 2 weeks' time, for argument's sake. I know I'm simplifying the scenario. And the balance, the next or last from yesterday going back 20 years. Okay? So what about the pro forma that brings this into play, i.e. the ID rules? Well, here we have it. Okay? Now, it's a little bit complex looking, but it's not complex in practice, in my opinion. Okay? So let me take a look at the top of it first. Bear with me 1 second. So in order to do a calculation, in other words, in order to calculate the gain, we would have to consider this pro forma. Okay? So what do we see here? Well, I'm just going to get the right top part. Okay? What we see here is several columns and indeed the three areas that we saw above. Same day matching, shares acquired in the next 30 days, and shares held in the pool. So this assumes a scenario, let's say with the 100,000 that we talked about, your portfolio of shares, that yeah, you had purchased some same day, you had purchased some in the next 30 days, and obviously there were a number held in the pool, and you had to go to every area. So you'll actually see three different three-liners here, because in essence what's happening is that the examiner is prompting you to calculate a gain in relation to each batch if they're relevant. So the flip side of it would be, well, I didn't purchase any today, same day. Okay, well, if you didn't, then go to the next 30 days. Did you purchase some in a few weeks' time? Well, no, I didn't. Okay, well, then go to the next area. They must all be historic purchases from yesterday backwards. There would be your calculation. Okay, so you would just pool gains and losses and indeed go from there in terms of the calculation, which is here. Yeah. So in terms of bringing figures up top, you see here, yeah, that the working is, broadly speaking, just a chronological average cost pool. So in other words, from the year dot, 20 years ago, you simply make up this pool, shares held in the pool, by adding in acquisitions, bonus issues, and indeed rights issues to get to, yeah, the disposal date. So in essence, number and cost, yeah, chronological order, getting right up to date, and then on an average cost basis, extracting the number that's relevant, because it may well be that you haven't sold all the shares in the share pool. Okay? Now, that's a lot of information for you to take in, I know. Yeah, I accept that. But in essence, just in terms of a summary, let's just say we're talking about selling shares, the disposal of shares. We're saying that identification or matching rules are relevant. Yeah? What does that mean? Well, it means that you have to match in this order. Yeah? You've sold 20,000. Well, did you purchase any same day? No. Did you purchase any in the next 30 days? Yes, I did. Take them. Yeah? Did you purchase any previously? Of course I did. I've got 100,000. Well, take some of them too on an average cost basis, as you can see below. Okay? So, moving from there, now, In terms of the pool, remember the third area, I mentioned bonus and rights issues. Okay? So, over the last 20 years, I could have just made, 5 or 6 different acquisitions, but also the company could have had a bonus issue or a rights issue. Quite straightforward to deal with, and maybe you're familiar with these terms anyway. A bonus issue is basically just new shares. So the company issues shares at nil cost to shareholders in proportion to their existing shareholding. In other words, if I hold 5 shares and the company does a bonus issue and says, okay, we're doing a bonus issue 1 for 5, okay? For every 5 that you have, we'll give you 1 at no cost, okay? Well, that means at the end of the day, after the bonus issue, I've got 6, okay? Now, in terms of the flip side of that, what about a rights issue? Same sort of thing, but this is at a cost. This is where, in effect, shareholders are invited to take up their rights, yeah? So, for example, I have 5 shares in a company. The company's doing a rights issue because it wants to raise cash. It says, oh yeah, we're doing a 1 for 5 rights issue at a reduced market value. That's what makes it attractive. In other words, shares issued at a discount, yeah, in proportion to shares already held. So, works the same as a bonus issue, but you actually pay at a discounted value. Okay? So remember, those 2 areas, bonus and rights, relate to the pool, the third area of matching. Okay? Now, next area, a little bit tricky here, reorganizations. So we've talked so far about basic disposals of shares, we've talked about valuations, we've talked about ID matching rules. Now we're talking about something that's a little bit different where companies reorganize share capital, or if you will, put simply, where we have a situation where maybe one company buys another. So let's just say we have the share capital of the company is going to be reorganized in specific circumstances, e.g., where we have a takeover. Yeah? So the shareholders of the old company, yeah, receive shares in the new company and maybe some cash too. So think about it. We've got company A, we've got company B. Yeah? Company A is the predator. Yeah? Company A comes in and says, oh, we're going to take over company B. Now, company B has shareholders, okay? And what company A do is say, okay, well, listen, we're a very, very large company. We're going to give you, let's say, 2 shares plus 50 pence, yeah, for every 1 share in your old company that you hold. Is that acceptable? Yes, it is. So, in effect, what we have there is a disposal, don't we? Because we have company B's shareholders disposing of their shares to the other company in relation to the receipt of 2 shares plus some cash, 50 pence. Yeah? So that's the sort of intro. In effect, what we're talking about is broadly a share for share exchange. We may have a situation where it's just shares, there's no cash. So what do we mean? Well, a share for share exchange basically means company B's shares are exchanged for company A's shares. Now, what's the tax situation here? Well, there is a no gain, no loss disposal of the old shares at that date. And indeed, the new shares assume the cost, indexed for corporate shareholders, obviously, and the date of acquisition of the old shares. In other words, in effect, the new shares received stand in the shoes of the old shares. You're basically just swapping. There's been a disposal, but because of the tax rules, there's no gain or loss. Yeah? Now, when the new shares, i.e. companies A shares, are sold, let's say 5 years' time for argument's sake, yeah, the gain or loss is calculated by reference to the deemed cost of the old shares. So really what you're talking about here is companies being reorganized because, let's say, there's been a takeover. So there is a tax transaction, but under the UK rules for reorganizations and indeed a share for share exchange, no gain or loss at the time of disposal. The gain or loss is calculated when the new shares, company A shares, are subsequently disposed of. So we just need to watch for this in questions. A little bit tricky, I would admit. Now, what if it isn't just a share for share? What if company comes in and says, okay, we're going to give you shares, but we're going to give you some cash? Well, then HMRC want a piece of the action. Then the situation slightly changes. So where the new asset comprises of shares plus cash, no gain or loss disposal, certainly in relation to the shares, but in relation to the cash, there's an immediate, what we call part disposal. You remember the part disposal formula, A over A plus B, yeah? So the cost of the old shares must be apportioned to the new shares and to the cash. Look for example 3 within the study hub. So again, a lot of information here, but in summary, I'm just basically saying, okay, you got a takeover, yeah? Is it just an exchange of shares for the old shares? Yes, no gain or loss. Is it shares plus cash? Well, no gain or loss, but in relation to the cash element in proportion, A over A plus B, then there is a chargeable disposal. Okay? So, a lot of information there for sure. Your ears and eyes must be ringing. Thanks for bearing with me. Thanks for listening. In terms of emphasis here, for me, certainly the big thing is the ID rules, the matching rules, and indeed rote learning them. Note that there's a very similar set of rules, not exactly the same, but very similar for companies. In other words, where companies dispose of shares. As mentioned, slightly different, but similar. But I think that the examiner favors disposals of shares for individuals, not for companies. Okay, so I hope that all made sense, that your studies are going well, and that you're beginning to understand chargeable gains in CGT, and that penny is starting to drop for you. Okay, thanks very much.